If I buy something from you, it's not the end of that money. You get to take and use it again, and then someone else uses it. So, this whole notion that there's a finite pie, I wrote about it in my first chapter of Killing Sacred Cows.
Yeah.
Well, people think money and pie are the same thing. They're not. Even if there was a finite amount of money, they're printing it while I say this or adding it to screens.
Yep.
There's an unlimited number of times it can exchange hands. So the more frequently it exchanges hands because of goods, services, and experiences of solving problems, serving people, and delivering value, the more wealth is created. So exchange actually creates wealth. Money can be complicated. Let a nerd help you. We're here to demystify the complex nature of money by getting you answers from financial nerds and whiz kids. Welcome to Ask the Money Nerds, a weekly segment of the Wealth Labs podcast where we answer your most pressing money questions. What's the best way to pay off loans? I mean, when does it make sense to use your retirement funds and those kind of plans before you retire? And how do you protect your money? How can you get your money to be more useful and keep it in motion? And how can you coordinate assets to get way more bang for your buck? Stoba, let's answer it.
Those are all great questions. And it's inspired by Nehemiah's question.
Nice.
So Nehemiah, this is what he wrote in with.
How's your latte I made you?
Oh, it's great. I love it. Oat milk.
Oat milk latte. Hey, there's been a run on the oat milk I use, so I now found some and had to treat it like it was toilet paper in a pandemic. I now have a huge fridge just dedicated to the oat milk for my latte practice here.
I love it. I think the latte impaired my speech there for a second.
Well,
Okay.
I didn't put any Baileys in it.
It's not an Irish coffee?
No. All right.
Okay. Here's what we heard from Nehemiah. I'm considering withdrawing money from my active 401k. Right now, the potential plan is to take that money, which is about $50,000 after assumed tax, to create an overfunded whole life policy for both my wife and myself, and then withdraw as much of the immediately accessible cash value to pay off all remaining debts, and then fund our peace of mind account. The thought process here is to have interest growing on the entire $50,000 and pay that all back gradually with the income from our current jobs until we can eventually replace our incomes with investments. My wife isn't completely sold on cash flow banking because she's never heard of it, and she's of the opinion that if it isn't broke, then don't fix it. Or if it isn't broke, don't break it. With our current situation, how would you go about handling the 401k money, the debt payments, and the availability of cash? He says, thank you for your advice. I've read all your books and Kiyosaki's and others in the attempt to become financially mastermind sooner rather than later.
A financial mastermind or financially mastermind?
A financial mastermind.
Hey, I'm here to help you out today, Stoba. I know it's been a long week for you.
I need you today.
Yeah, you can lean on me. And you said I wouldn't be able to make you laugh. I've done pretty good so far.
Yeah.
So mostly at your own expense, but
Should
it's
we
fine.
make everybody else laugh and sing Lean on Me together?
So if it ain't broke, don't break it. Let me say this. That's what you said. If it ain't broke, don't break it.
That's what it says in the question.
Well, I'm saying that's fine.
I'm telling you, that's why it threw me off.
The problem is 401ks are broke
because
your partner is the government. They're $27 trillion in debt.
And counting.
And you're not saving tax or deferring tax and delaying tax. And because of inflation, you're going to want a lot more money in the future. And because we've got someone here reading books and doing the work, he's going to be wealthier in the future. So don't just defer those taxes into the future and go, oh, now everything's fine. Because right now there is a provision where you can get that money out without the 10% penalty potentially because of COVID. But let's start to break this down. First is you're not just going to cash this out and put it all into cash flow banking because of the way cash flow banking works. There's modified endowment contracts, which you can only put a certain amount of money before you lose your tax benefit. But getting it out of the 401k still is an idea to maybe talk to an investment advisor and really look at. Most investment advisors are pro retirement plans because they get paid on them. I'm not really a big fan of them. Okay, but then he's saying go to an overfunded cash value policy first, and that could be a good idea, but here's the things to watch for. Number one, it takes a bit to capitalize. So let's just say you could put 50 grand in there. You're not going to have 50 grand in the plan because there are costs. Some might point that out as commission costs and all that kind of stuff. What it really is that the overall commission costs are kind of spread over time and paid directly from the company, but obviously they're profitable because of these plans. So there's reserve requirements that are there. There's those factors that kind of go into this. And so you're not going to have the full amount in there. So you got to look at that first and foremost. Then second, I like that he's talking about putting this money into cash value, then utilizing the cash value to pay off the loans. And if those loans are charging more than what you're earning in the policy, then do that, right? Because then you're paying that off. And then you can take the money that was going to the loans and pay back the policy. Because now you can do is you get your cash value, you get to use it as collateral. The insurance company will lend you money at a very preferred rate. And then you can pay that back on your own terms. It doesn't impact your credit, but you're going to free up that cash flow. And what's nice is your money's still in the cash value, earning interest during that time.
Sounds like a lovely thing.
So you're earning interest during that time. Yes, you're paying interest to the insurance company for lending you the money. But at the same time, this is going to be on your schedule now. You can decide how much you pay into it, how much you don't pay into it, where the other, loans are fixed prices. And a lot of loans right now are pretty competitive interest rates. So we also want to look at that. Mortgages are at pretty much like an all-time low as we're recording this.
Yeah.
Even car loans are very inexpensive if you have the right credit. But I do like the way he's thinking because I look at this as money in motion. So I have my cash value policies, right? I put extra money into those policies. And early on in my life, I used to use the cash value to make down payments on real estate. Then I would get the real estate. I would take the rents from the real estate to pay back the cash value.
Yeah.
And then one time I started to use that cash to do hard money lending, which is I was actually a bridge financer. Like someone would find an awesome deal on a property and they'd need to act quickly. So I would charge them a bunch of money, like 10%, right, for having this money for 60 days. So, it's a pretty good rate of return when you think it's really more like a 60% rate of return annualized. So I was getting a really good return, but I was giving them access to cash they didn't otherwise have. And then when that money would come back in, again, I'd be buying property and paying down payments and using the renters to pay that back and then buy more property. So it was kind of the keeping money in motion. And I like that
quick
thought process.
Turnover.
Because he's not just thinking about setting it and forgetting it and just waiting for 30 years hoping it's going to pan out. He's recognizing, hey, I can start building this cash reserve that I can use when there's good things to invest in. But right now, the best thing to invest in might be paying off those loans, freeing up the mind, the mindset and all that kind of stuff. And, not doing the retirement plan, kind of a good idea.
I know this might be a little bit difficult to answer, but when someone's taking money out of their policy, what is the interest rate on that versus what they would get if they had a loan at a bank? Like, is it drastically lower or? It
depends on the person.
Okay.
So I was speaking at an event a couple of years ago and there was a guy that does a lot of life insurance, loves my books. And he came up and he's like, hey, we actually have a deal right now where Bank of America is using the cash value as collateral rather than the insurance company. And they're only charging 2.75%. And that was when interest rates were a little bit higher. So that might make more sense because some insurance companies might be charging 5% right now. And 5%, for a collateralized loan isn't a great deal. It's a great deal during other times because a lot of times when interest rates are really high, which they haven't been for a long time, you're getting a much more preferred rate from the insurance company than you would out there in the marketplace. In today's time, though, interest rates are so low out there that if you have the right credit, the right collateral, you might be able to get a better deal from a bank, but you're now using your credit. You're now on the bank's payback period. You have more restrictions. You're jumping through more hoops versus just filling out a form or making a phone call and getting the money sent to you.
Yeah.
So you got to look at the ease, the convenience, and the quickness of just using it from the insurance company standpoint. But I like your question to look at what makes more sense,
Yeah.
All right, let's talk,
So when you were talking about money in motion, you were referring to velocity.
Yeah. So
or is there more to that piece of the conversation?
So to define velocity versus accumulation, this is something I learned in my early 20s. It's kind of like an economic concept, velocity is, and it's how the economy's measured or how it works a lot of times is we take the output of an economy, which is the GDP, gross domestic product, divided by M2, which is the money supply. So simply it's just output divided by inputs, right?
Okay.
So
simple enough.
So, and what it does is it tells us a number, and that number is how many times did money exchange hands that year? The more frequently, the higher the velocity, right? Because if I buy something from you, it's not the end of that money. You get to take and use it again, and then someone else uses it. So, this whole notion that there's a finite pie, I wrote about it in my first chapter of Killing Sacred Cows.
Yeah.
Well, people think money and pie are the same thing. They're not. Even if there was a finite amount of money, they're printing it while I say this or adding it to screens.
Yep.
there's an unlimited number of times it can exchange hands. So the more frequently it exchanges hands because of goods, services, and experiences of solving problems, serving people, and delivering value, the more wealth is created. So exchange actually creates wealth. And so the more velocity that we can create, the more wealth. So how does this apply on a personal level? Well, there's the Stolva output divided by input. So if I tell you to take more risk, that's an input. That doesn't help you out. If I tell you to add more money, well, that's an input. That doesn't necessarily increase your velocity, right? And that's where a lot of people are at their finances is, take more risk or set more money aside. So what we focus on is how do we keep the inputs fixed, but increase output through velocity.
Okay.
So there's two main focuses for velocity. One is efficiency. If something's more efficient, it's going to, travel further essentially.
Yeah. And this is when you would encourage someone to look at their insurance policies.
Yeah. Is there duplicate coverages or
interest
costs?
rates on their credit cards?
Can they renegotiate or lower their interest rates? Are they overpaying on tax? Are there hidden fees or commissions in their, investment plans? So we're just finding money. That's part of the efficiency. So that intelligence or that knowledge increases the output without you putting more input in. It's through savvy. The second thing is expansion. So expansion can be scale. It could be motion. And so if I've got, let's say $100,000 that is now kicking off cash flow for me. When I first did this, I had $100,000 that I was doing hard money lending with, which was consistently getting me 1% per month. So I'm getting $1,000 a month. I was taking that $1,000, I was putting it into my cash value, right? Then that cash value was growing, and then I was buying property. That property would appreciate. I would refinance. I'd put more money in hard money lending. And so all of a sudden, I'm getting more turns on my money. I'm getting the interest from the first investment. I'm buying real estate. I'm getting tax benefits. I'm getting cash flow. I'm getting appreciation. As it appreciates and I refinance, I'm putting more money in the front end hard money lending fund. And so I'm keeping money in motion. I'm not trying to utilize accumulation, which is all about, okay, if I want to be having more money in the future in accumulation, it's how much money can I put away, right? That's the budgeting, takes money to make money kind of thought process. And then it's how do I get a better return, which most people think to get a better return, they take more risk, but risk equals a higher chance of loss.
Yeah.
And then the third thing is, it's all about how long can I wait? Compound interest will come in and save me. The problem is accumulation is a slow, tedious, dangerous process.
Is that because your money's stagnant?
It's
just
very
sitting
stagnant,
there, right?
Compound interest doesn't look good in the first 5 years or 10 years. It looks good in the 20th and 30th year. And then there's a lot of things that can trip you up along the way. Financial disasters or concerns or financial crises or collapses, or there's just so many things that happen along the way. And I think that all institutions, especially banks, are going, we want cash flow. Yet they're telling you, you want to accumulate. Well, they get cash flow. So
different story.
So I think cash flow investing is really a completely different methodology that's a much more impactful, it's safer, but it requires more effort. It requires more knowledge. It requires, participation. It requires like doing something instead of just handing things over. So I like having cash value because if I don't know where to invest in the moment because I don't think it's a good time, or I just want to take a break and I just want to, have a sabbatical where I'm writing and I'm not focused on those things. I know I'm storing my money in a place that's protected on the downside, not participating in a recession, getting a guaranteed interest rate once it's paid. A dividend becomes guaranteed once that enters the plan, and it's available to me along the way. So where people dislike it is because so much of it's designed poorly. It's high commission, low cash. It's with these companies that weren't really designed to offer these types of plans, or people that skip steps and take more risk by moving to index type things that have volatility within their fee system or within their expenses. And so it deserves some of the bad reputation it gets. But if people, as he says, his wife has never heard of it. Yeah, there's a lot of things that people probably haven't heard of with finance. Like they probably never heard of private placement life insurance. They probably never heard of premium financing. They probably never heard of charitable remainder trust. They probably never heard of a Section 1202 for selling a business. But these are the things that the wealthy people have been doing for an extraordinary long period of time that didn't trickle down to the middle class. When I wrote What Would Billionaires Do, I was like, how do I take something that the wealthiest people do and find a way to design it for anyone, even if they just have $50 a month, and make sure it's available. It's not identical, but I at least took the main concepts to provide that benefit, because unfortunately if you're super wealthy, you can get stuff without commission, right? Or you can have it specialty designed and you can have it more cash heavy because of the way that it's built. But there are ways to at least mimic that to a certain degree. So the lesson here is money in motion and velocity over accumulation. And that I like the way that he's thinking, and have a read What Would Billionaires Do? They can go to billionairesmethod.com, and it's super inexpensive. I think it's a few bucks to grab that book in PDF or listen to the audio.
Yeah. So if they don't have the policies that you're referring to and have that situation with the real estate that you were using to keep your money in motion, if someone's a W-2 employee or they're just getting started out, what's one thing that they can do to keep their money in motion? Because it's not just about going to Target and, buying some things, right? Can we expand that for the person who doesn't have these policies?
All right. So here's what you do. You've got to start with building savings. Not investing. People call their 401k a savings plan. It's an investment plan.
Yeah.
Savings is available, liquid, safe. It probably isn't earning much money. Don't worry about earning the money. Have that there so you have peace of mind. As soon as you have a little bit of money there, now you can go, and here's the velocity for you. You can go change your deductibles on your car and your home, or your elimination period on your disability policy, or, you can start to drop coverages because you've got the ability to handle the small things, which can save you a bunch of money.
Okay.
There's a first step. And then you can start looking at, well, where else can I create velocity? Well, if you're buying term insurance and investing into your retirement plan, it looks good on paper in the immediate moment, because when you get that retirement plan statement, it looks like, oh, I've got $10,000 in here. No, you don't. You've got $10,000 that the government still has a right to take their fair share of. And fair is a pretty,
what
nominal
is fair
word.
when it comes to the government?
I'm using their terminology, not
Right.
mine. And so when you go to pull that out, they're taking tax and potentially even penalty based upon when you take it out. So it looks good on paper, but it doesn't deliver in reality because of the net of expenses and fees and taxes. And then you still have this term insurance that eventually becomes so expensive that if you live to life expectancy, you'll pay more for term insurance premiums than the death benefit, because it's cheap when you're not going to die.
Right.
It's super cheap. But it's expensive when you don't have it. Where here's the deal. We're all going to die. And even if Ray Kurzweil figures out how to upload our consciousness to a computer, the bottom line is when you're 100 or 120, depending on the type of policy, they consider it a living death and pay out the death benefit. So why, when we know we're going to die for sure, would we drop insurance at the time that we have the likelihood of death? It makes no sense, but it's because people are measuring the wrong metrics. They don't understand how to look at this. And so if you actually can move to an overfunded cash value, you're going to get some velocity because you're going to save on term insurance premiums.
Okay.
You're going to save on taxes, not just temporarily, but there's ways to permanently save, unlike the deferral of a retirement plan. You might be able to save on long-term care insurance because there's riders that allow you to access your death benefit if you need long-term care, which might create, once again, another benefit there. And that money's available to you. So if you have to pay off high interest rate loans, it's available. Versus it might not be as available inside of a retirement plan because there's restrictions on how much you can take out, and there's restrictions on how you have to pay it back. So that's easy velocity. And, for someone that goes, I'm a W-2, I don't want to deal with money, I feel better about them just putting money in cash value and sitting on that than trying to put money in mutual funds, which are highly volatile, which are hard to understand, which don't create any cash flow, which create a lot of stress during downturns for people that have worked so hard for their money, then they find out their money's not really working for them at the level that they thought. So stability and security, and giving them that peace of mind so they can continue to live a good life, versus taking risks and go, I lost so much money, now I'm depressed for months at a time, right? So, yeah, long answer to your question, but hopefully that helps out.
Nailed it, Gunderson.
Worried your 401k is going to turn into a 201k? Want to know if you can ever get to your money, whether these plans are right for you or not? Well, I've got some videos on it. Just go ahead and click right here.